that's dealing with short-term interest rates. Long-term interest rates like 10-year treasuries, that's more of a global product. I think the yield curve remains inverted, meaning short-term stays higher than long-term, mainly because other parts of the world, like Europe, are probably going to start lowering their rates pretty soon. They have different economics going on in their own economies, right?
Welcome to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers. My co-host Ian Horowitz from Equity Warehouse. If this is your first time tuning in, welcome. We certainly appreciate the support. And in a second, we're going to bring on a guest that I know you guys are all going to love, and we'll get as much value and dig deep out of him as we can. Actually, going to be talking about commercial real estate finance, which is a topic that I love talking about as well. So looking forward to that. If you are a return viewer, watcher, viewer, follower, thanks again for all the support. We couldn't do it without you. Ian and I really enjoy doing this show and bringing on a lot of active real estate investing guests. So we want to make sure to bring you as much value as possible to here today.
Yeah, no, I'm excited to see if he knows the answer, if the Fed's going to lower rates or what's going to happen. But, before we do that, guys, if you get any value out of this, as always, please feel free to share. It's the best compliment you can give us. We don't care about the 5-star reviews or any of that type of stuff. Share it. You got value out of it. One of your friends are going to get value out of it. And that's the best thing you could do for all of us, and including the guests who come on here and spend their time telling us about their fun stories. So with that being said, I just got back from Fresno, California, speaking out at the Deal Champs Summit. Hey, Jay, check this one out. For those of you that are watching, I got my very own bobblehead now. That was the guest speaker, one of the presents, which was really fun. But my allergies are killing me. So if I'm on the sidelines, Jay's doing all the talking today. Fresno is a wild place because that's where they grow all the nation's produce. But enough about me, enough about Jason. Let's bring Jake in from Clopton Capital. What's up, brother?
Hey guys, appreciate you having me on.
Yeah, man. Where are you out of?
Chicago,
the big windy city.
There you go.
What's your background? How'd you get into commercial financing?
Okay. Yeah, that's a good story. So before I started this company, I traded interbank hedging product futures, which is basically 3-month LIBOR futures. And, if you're not old enough to remember LIBOR, it's the rates that got phased out before SOFR. So I was trading those around before the financial crisis era. And then when 2008 hit, 2008, 2009, that whole market just kind of evaporated overnight. So I was kind of looking for something else to do other than trading interest rates. And at the time, everybody was talking, there's the residential mortgage crisis. And then everybody kept talking about all these commercial loans that were going to come due in this wave of commercial debt. And there was a liquidity crisis, right? And so I had the idea to create a company that helped people find money and find loans and kind of take advantage of transaction costs, because I didn't have hundreds of millions of dollars to lend out at the time. Really it all started from that idea. The way that I got into it, because I had absolutely no background in real estate or brokering loans or anything like that, is I literally just started cold calling, lending sources, anything I could find. And if you remember 2009, if you just had a lender that was actually lending, people would just kind of pile on and come to you. And then, ever since then, that was 15 years ago, man. And that's kind of evolved since there. Now we've developed into more of a commercial real estate services firm, where I still run all of our capital markets, which is the loan brokerage side. But we're also a nationwide commercial property insurance company. We're a 1031 qualified intermediary. We do commercial solar and we do financial modeling, mainly for syndicators and stuff like that. We're looking at trying to wrap in the brokerage side, but that's coming in the near future. So that's us, man.
So wait, so when you say wrap in the brokerage sides,
real estate brokerage,
real estate brokerage, got it. Not
actually, because a lot of it's all the same people, right? And if you kind of look at like a HUD statement, there's a whole bunch of people on there that are, participating in transactions, and we're kind of trying to, participate up and down that stack.
Yeah.
So, we've really looked at, bringing on more team members that, can add value in different areas. And we've had a lot of people that, on one single transaction will use us for financing, insurance, 1031. And, we're kind of trying to wrap in solar and a lot of that too. So, finding people property is something that people ask quite often. And candidly, I'm not a licensed real estate broker now, so we can't really do that. But people constantly ask us hey, if you know somebody who's selling something, or a bank that's selling something. And a lot of times we actually do, or it's very easy for us to reach out to our network and find stuff that's either off market or just not really marketed well. So, it makes sense.
Yeah, I agree. We get that going on a lot.
Sure.
Yeah, it's interesting. So what's going on inside the capital markets currently? Or is there a lot of liquidity in this space, and is it very, very easy to get capital, or do you feel like all these capital sources kind of are just wait and see, and they're shy, they're more conservative? What's your pulse on the market?
So it's definitely changing, right? As in real time, because rates are all over the place, man. I think just a couple of weeks ago, the 10-year was 100 basis points lower, and now it's back at 4%. So we pitch deals to lots of different capital sources: banks, credit unions, private debt funds, life cos, government agencies, CMBS. Shockingly, our biggest capital source is banks. There are really three types of banks you run into right now. I have something 15, 16 deals under term sheet right now that are going through the closing process with local regional banks. To give you an idea, when you reach out to banks today, you're going to run into three types of them. It's banks that don't have money and they're not really lending. There's banks that want to lend, but and I'm sure you've run into this, they're going to ask you for large deposit relationships to lend you money. I had one bank ask me for, I think we were going to do something like a $7 million loan with them, and they wanted 30% compensating deposits to do a $7 million loan. I'm like, what are you talking about? Are you guys even lending, right?
Right.
I don't know, it's ridiculous. And then, I run into other banks that actually have tons of money to lend out, shocking. The problem is you don't really know which type it is until you get in there and kind of go through the process. And a lot of times the loan officers you're dealing with don't really know either. And they'll find out later on when they try to take a committee or they talk to credit officers. So it does take, if you're going to deal, if you want a lower cost of capital, from a bank or credit union, it does take more work to actually find the deposits of money that are there for these banks to lend out.
Yeah. So is a real estate investor that, whatever is buying that particular property, does it behoove them to go directly to the bank themselves, or to go through someone like you that can potentially facilitate the right capital for their particular situation?
Well, I'm always going to say it makes more sense to go through us, which I think it does. If you have let's say you have huge deposit relationships at some local bank and they're your bank, they should be doing the loan, right? But if you don't have that, right, then it does make sense to bid it out to really as many banks as humanly possible. I've been doing this for 15 years. What we can do exceptionally well is wrap in basically every bank and credit union that can even geographically lend on the thing just through our process, and which, could equate to, well over 200 bankers, and talk to all those guys and give it maybe a week's time. That would be extremely challenging for your average person to try to do. Candidly, most of the time people reach out to banks. It takes, you call the bank branch number, right? And you're like, hey, I want to talk to a commercial real estate lender or business lender or whatever. And they don't call you back for a week and a half. And that's just one. Imagine doing that 200 times, right?
Yeah.
So it does take a wide net cast approach. And that's really difficult, especially when you're under contract and you're under a time frame, right, that you need to get it done. I just don't see how somebody who doesn't do what I do could possibly do that.
Yeah, that was the biggest change in our business, going from single family real estate to commercial real estate. single family. I'm like literally like, here's my firstborn, my secondborn, literally everything. By the way, we already bank with you and you still want all of our shit from us. We're like, dude,
Right.
what are you doing? Like, we made the move to only bank with you, and then you won't give us the money. It was like such a fight. Then you go to commercial real estate, and it was like, holy shit, everybody wants to lend, and it's almost overwhelming. Guys, just to be transparent, we don't use Jake, not because we wouldn't want to. It's just we have a relationship here with us. But that mortgage broker that I deal with, and it's like the Rolodex that opens, and it's like, this guy's going to give you money. This guy will give you money. What do you want to do? How do you manage that process for a real estate investor to say, hey, I think this is your best option? Or how do you get them to make sure that they're taking the right debt with the opportunities that are presented to them? Do you show them all of them, or do you narrow it down to the best three and say one of these three options is your best?
Yeah, I mean, I like to understand deals a lot of times from like the equity stack down, meaning like what's the actual strategy with this property, right? And then that kind of points me towards like what are the right terms and what are the best lenders to use. I mean, when you're getting like, okay, so right, so we go out to like, let's call it, we go out to 100 bankers on it, and that ends up resulting in somewhere between 5 and 10 actual term sheets, right? A lot of those are going to have pretty similar terms. But, there will certainly be nuances, prepayment penalty differences, amortization differences. It's not just interest rate, right? I mean, a lot of your cost in deals doesn't come from just your interest rate when you actually look at what your strategy is for this deal. Like if you just take a lower rate, but you have a stricter prepay, your IRR at the end of the day is going to end up being lower, right? Because it costs more to get out of it when you want to do it, as an example. But there's another consideration, especially when dealing with local banks, and it's really certainty of closing and not like kind of getting retraded and making sure that like those terms are actually going to come to fruition. And that's what's really difficult to flush out of these guys. And, if you're not pushing them really hard to understand like their internal bank credit process and understand like, because a lot of when you go to a banker, just like a loan officer, they can just send out a term sheet on their own. Like a lot of these banks don't require any sort of like higher credit, like sign off or anything like that. They'll just fire out a discussion letter, right? Or a term sheet. And, you'll think that it's an underwritten deal and that those are the terms, but they're going to change wildly later on if they haven't fully underwritten this thing. And a good example is if you just send, a budget pro forma or something like that, and you get a term sheet back with just that thing's probably going to change because these banks need to globally underwrite all of their deals. And then they have to get, go up further up to their credit guys up above that. And then they have a committee level above that. So what I typically like to do is really vet these term sheets and make sure that somebody higher up, at least like whoever the banker is, like the loan officer, make sure that they vetted this with their like senior credit guy. And also that, they've actually underwritten the deal. Like all of them will have an underwriting department and make sure that like they've spread all the global tax returns and all this stuff before we really move forward. That's really the only way. Otherwise, I tell you, like 9 times out of 10, something will come up and they'll say, oh, we got to change terms because of X, Y, Z reason or something like that.
Yeah. And I would definitely say that like my experience so far, and I'd be interested in your comment on this, as capital markets are continuing to change, is our best success has been with life cos as of recent, just because their ability to navigate their markets, the ability for decision-making power, no banking relationship from a deposit standpoint has allowed us, because we have a national presence, semi-national presence. There's a little bit of a pain in the butt sometimes when you're dealing with a little town in Mississippi and you got to establish a banking relationship. For us, Lifecos has been the direction that our banker has pushed us towards until stabilized. Then we have the discussion on refis of where we're going to place the debt afterwards. What's your experience been versus, banks to credit unions to Lifecos and, all the, CMBS and everything else in between? What do you think the front runner is right now, if you had to take a guess, for most value add deals? Because most investors are looking for value add type stuff.
Most value add stuff. If you are let's call it like sub $5 million financing you're looking for, I wouldn't even bother with life co's. Like a lot of them just really aren't in that space. If they are, they're probably looking for really super simple deals. Then you're really in the bank and credit union space. If you're syndicating equity with investors who don't want to sign on recourse, then the credit unions are all gone, right? Just because of the way that the vast majority of credit unions require, their memberships. It just doesn't really jive very well with syndicated equity for the most part. So that really kind of brings you back to the bank space, right? Especially when you're dealing with like secondary or tertiary markets. I mean, a lot of times they're really the only game in town, and banks really are the largest lending, source in the country. The issue is it's so fractured, and you're dealing with, most guys that really don't have that much incentive to push your deal through. So, here's a great example. Sometimes when we reach out, I'll reach out to like 3 or 4 bankers at the same bank because I'll get 3 or 4 different answers depending on how the guy's day is going. You know what I mean? Like one guy's off of paternity leave, the other guy's on a golfing trip. This guy doesn't want to deal with it just because he just closed a deal and he doesn't think it's worthwhile. And then you find one guy that, needs some business and, he'll push it through. So, that's kind of the challenge with dealing with a lot of banks. It does take, a lot of effort to really get through to what you potentially could get. And a lot of times, like taking the first answer is not really the right one.
Yeah, and I mean, also most of these places, I mean, maybe not local banks, but they're not all that consumer direct. I don't even know if they have any consumer direct, right? Like, it's not like you can just reach out to a life insurance company. So, like, they need, somebody, an advocate like yourself, like your company, that understands this space, not just for like education purposes or hey, who to use, but it's like you don't have an option to pick up. There's nobody to call, to make this introduction for you as well. I've got, just a little bit of context. I've got, a guy that I know in, similar in this space as well. And he's like, I could tell all of my people up front who to use, but like, they can't use them without me. I've got the relationship with them. I have this set up. I've vetted them. Like, it's not that easy to do that. And, let's be honest. I mean, there's some investors that obviously, own tons and tons and tons of real estate, but a lot of real estate investors might only own a few apartment buildings or a few office buildings or a few self-storage facilities. So like, they don't know. And, they might call, hey, let me just call Wells Fargo and I bank with them. And like, they say no, and that works. I mean, even on our end, on much smaller balance type of stuff, we have very sophisticated people that we'll do loans for that they'll call Bank of America and be like, oh yeah, I don't do investment property loans or fix and flip loans or construction loans or rehab loans, or it's too small, whatever it is. They'll be like, yep, my bank said no, you're my only option. So
right. I mean, imagine some guy that has like $1 million sitting at Wells Fargo.
Yeah.
Hey, you have all my money.
Yeah.
Okay. They don't care about your money. Like,
they don't care about you. It's a lot of money to you, but it's not to them.
Right. No, you're absolutely right. I mean, the other thing about this is, like I've been doing nothing but presenting loans for 15 years, right? I would tell you, like, this business is almost more art than science with a lot of these guys. And it's really like a lot of it comes down to just presentation, right? I mean, the way that a lot of like we take stuff in and real estate investors like present stuff to me, it is, unless you really spent a lot of time packaging this thing the right way and presenting it the right way, it is so all over the place, missing information, this, that, and the other. And again, think about, somebody who's a commercial real estate guy at a bank, right? Like if he gets that sent directly to him without, me putting it together the right way, he's just going to completely pass on. Like, it's just not worth his time. Like, a lot of these guys are just on salary,
Yep.
So, with maybe like a bonus incentive based on volume. And it just, they're going to completely, ignore it.
Yep.
So, there's that consideration too, where like, knowing how to present deals the right way and also pitch them right. And candidly, with a lot of bankers, if you do too good of a job presenting it, they think it's being shopped all over the place, and they'll ignore it. So it's like this whole presentation aspect with local banks, local regional guys is definitely a little bit of a dance.
Oh, excuse me. That we found that early on is we started really leading on our fire. My business partner and I, we were firemen for the city of Baltimore. We really started to lean on that, and it was an easy thing for someone to take and go back to their loan committee to say, look at the 2 local firemen who are investing in real estate to secure their retirements, and they care about the local markets because they know and understand them. And we found out that was a really good thing to rely on that allowed us to get some loans that maybe we should have not gotten at the time, but have allowed us to advance. Let's leave the audience with like a few action items. Like, what do you need from them to be able to present a good story? And more than just everybody understands there's a piece of property. Like, what else are you looking for to be able to present?
I mean, it's a lot of times it's just the usual suspects, right? It's, but it depends on what the deal is, right? If it's construction, budget performance, exec summary, all this stuff. I mean, if it's a stabilized deal, rent roll, P&Ls. But a lot of it comes down to like the format in which these are put together, right? A lot of times we'll get P&Ls and like it's, I'll have some guy that'll send me P&Ls where it's just his revenue on one PDF and then expenses in one number in another PDF. And then, like the rent roll just says like no names, no units, this, I think the easiest way to explain it is, you need to present this deal to somebody who knows absolutely nothing about it. And I think that gets lost in translation for a lot of people, because like a lot of people get so like in depth into their deals and involved in them, that to them, it's just a no brainer. But when somebody's coming in, they have absolutely no idea what's going on. They don't even know the address of the property, right? You got to kind of, present this thing where this guy's, whoever's going to look at it is going to get a great feel and know the economics of it there in probably about 5 minutes, from start to finish. And a lot of times just, it's just not presented that way. Or otherwise we'll get stuff in, from people and it's just all stuff in an email, right? I mean, it's nothing official documentation.
Piecemealed in an email.
Yeah, exactly.
Which is the worst thing in the
or
whole
like
world.
A million PDFs that aren't like,
it's like, come on, man,
labeled. And it's like, all right. I mean, but that's, we'll put it together the right way. And we'll I think if there was one idea to get across, it's, think about how to explain this deal to somebody who knows absolutely nothing about it in a quick manner, right? In a short amount of time. So that like, their eyes aren't going to glass over immediately when they're trying to figure it out and just pass.
Yeah, that definitely makes sense. I guess the $1 billion question, right? Everybody wants to know. Like, obviously, we need to get you information so you can go get us loans. Where are the markets going? What do you think is going to happen? I mean, I have a prediction. I'm sure Jason has a prediction. He's a lender, so he's equally as conservative, I'm sure, as you are. What's the expectation? What's the outlook for 2024? If you had to pull out the old crystal ball.
Well, you'd think I'd have a good idea considering it's trade interest rates for a living. It's going to depend on what the data says, right? I mean, it's funny. A lot of people ask me all the time, and I'm like, well, it'll be the higher, lower, the same. Which is, I know, just a ridiculous saying, but it's kind of true. But I would, because it constantly changes. Just a few months ago, people were pretty certain, the Fed funds rate was going to start coming down in June. Now we've been getting data that points to, the opposite, like inflation actually kind of looks like it's heating up again. And, there's a lot of the stuff that like caused all this, like, product inflation and in the world was geopolitical stuff. And it seems like, I don't know what you guys are reading, but it seems like that's starting to heat up again pretty heavily in areas of the world that have a lot of shipping and transportation, especially, with oil. And, that's going to put pressure on prices to go higher. My personal opinion, I think rates stay higher for longer. The economy is incredibly strong. Nothing has really broken like that badly, right? I mean, you've had some regional bank failures, but it just hasn't happened yet. I think, we're starting to see that. I mean, there haven't been that many bankruptcies. The labor market's still incredibly strong. Like, inflation is still, heating up again. So I don't think the Fed funds rate, is coming down anytime soon. Maybe later this year, depending on what the data looks like. But I would tell like equity investors, if any of your return is based on lower rates, I would be careful with that. That's dealing with short-term interest rates. Long-term interest rates, like 10-year treasuries, that's more of a global product. I think the yield curve remains inverted, meaning short-term stays higher than long-term, mainly because other parts of the world, like Europe, are probably going to start lowering their rates pretty soon. They have different economics going on in their own economies, right? And so, like for instance, if Europe lowers rates, one of the things we used to trade off is like the German Bunds, which is basically German 10-year, and that'll probably anchor, our 10-year treasury to a little bit lower level and kind of contain it. Similar to the way it did when those rates were negative, that was anchoring our 10-year to be a little bit lower. So you get a lot of like international pressure on long-term interest rates because they're international product, right? So I would say short-term rates, your Fed funds, which is also basically prime rate, SOFR, stuff like that, stays pretty elevated. And then we keep this inverted yield curve, because of anchored long-term treasuries. I would say, so I don't know. I mean, let's see what the data says. Maybe we get like a quarter point, reduction late this year, but I think next year is when it really starts. I mean, the thing is, I don't see any reason for them to lower rates. I don't think anybody sees an actual reason for it other than people just wanting them to, and that's not going to do it. What I mean? And candidly, inflation keeps heating up. Like, we had core inflation heat up. The chances of them raising them another quarter point are actually getting better. So, I would just be careful with anything that's projected, for short-term interest rates to come down. Now, cap rates, what this, translates to a lot of times in cap rates for, real estate. Most, real estate's a long-term, return product for the most part, right? And most of your cap rates are based on kind of where the 10-year treasury is. For instance, like multifamily usually trades at like a 215 basis point spread over the 10-year. So people are like, wondering, saying like, oh, cap rates need to be but so much higher because SOFR is here. You get a price against the longer term stuff, I think. So I think you get a lot of like this, like, negative arb and like short term rates for like people that are doing value add stuff. The cost of short term capital, which is construction and value add, probably remains elevated. And then, just be careful where you can get out of that stuff.
I would tend to agree. I figured 50 basis points at best. If we were so lucky, I think Powell has done a pretty decent job of staying non-political and not letting any of that get in the way. He's signaled both with Trump and Biden to just say, this is what it is, and this is what I'm doing. Leave me alone. So I give the man credit. I never really looked at it from an international standpoint. That's a really good point, and you're actually the first person to ever bring that up to our attention. So that's really interesting. We have another friend of ours who lends money, and he said until there's damage in the marketplace, people are unemployed, there's a lot of hurt, there's a lot of pain, you're going to expect to see the rates elevated for a while. And I know every time they say they're stable, everything goes wild again. So like, well, we can't do anything until y'all calm down. So it'll be interesting to see what happens. We both agree, Jason and I, Jason being a lender, me being an investor, that you're doing this for the long haul. You make deals work today. If rates go down, it's only going to get better, right? And if you underwrote correctly and rates go up, well, then so be it, and execute your business plan. Too many guys aren't executing their business plan, and I think that's the bigger underlying issue, because the tailwinds from basically 18 to 22 made a lot of syndicators really good operators, and they didn't have to do anything except show up and keep the doors and lights on, right? So it'll be interesting to see what happens. Do you think there's a commercial recession on the backside of this or during this, or you think stuff still going to actively trade?
I don't think there's a recession. I mean, I think what happens before anything else is the economics of these properties catch up to where the cost of capital is.
Yep.
As opposed to the cost of capital crushing the economics of them.
Yep. Yeah, I mean, that's the one good thing. They raise your taxes. Operators are going to start raising rents. Like, you have to. Cost of stuff. Like, your rents have to keep up with your expenses. That's how we've always looked at it. So,
and I mean, there was a period of rent slowing significantly down. But from what I've seen recently, it looks like rents are,
picking back up.
Yep. There is some legitimate concern on the expense side, right? With expense inflation. We're also an insurance company. Insurance is crazy.
Dude.
Especially if you're in Florida, New Orleans, anywhere.
High wind areas.
Anywhere where there's wind, it's crazy.
I mean, everything's under insured there, right? You can't properly insure what you're looking for, at least in the residential space.
Yeah. So the insurance market is weird. And as I don't run our insurance side, another guy does. And as I understand more about that, how that market works, right? You have insurance brokers, which is what we are. You have insurance companies, and then you have reinsurance companies. And from what I understood, the reinsurance companies or something like that were, like the amount that they were charging, was underwater by like 40 or 50%, which filters down to the rest of the system, right? And what we've seen a lot of times is like these insurance carriers just not just raise the premium, but just say like, we're out of this market completely. Yeah. Like in Florida and areas like that, like we've run into people that like just can't find insurance.
Yep.
Yeah.
We're in the Southeast. We have storage properties in Baton Rouge, and we have them in Mississippi. And I am concerned every single day about the wind insurance coming by and then just being like, we're done. A
lot of those are just doubling overnight.
100%. And it's scary, and we've lucked out so far, but I know a couple of my real estate investor friends that own storage facilities and said, dump my wind coverage to reduce my cost. I'm like, you are insane, dude. You're in North Wales. You're in New Orleans. You're in Midwest, dude. Like, you can't do that. That's not the coast where we are, where we don't get tornadoes, dude. Like, we don't have these issues or hurricanes like that. So it's wild. And the replacement cost, it's just going to be interesting to see what happens.
It's overall, right? I mean, you've got a guy that says, okay, well, I can either pay insurance and not make any money, or I can take the risk of not paying the insurance. And then, it's like, it works or it doesn't. Like the tornado rips this thing apart. I mean, the expense side inflation is definitely real, because we didn't really see that for a long time, right? I mean, all through the teens of 2000, right? It was just, you'd underwrite, you just put 3% on every expense number and extrapolate that out for the next 10 years. That was it.
And a lot of that stuff, I don't think even has been realized, because the cost of inflation increases haven't necessarily trickled down to real-time expenses even increasing on some things. I was talking to slightly separate topic, but I was talking to some guys that own quite a bit of residential condos. And I'm like, the condo markets I am very concerned about, because, I mean, condo fees, just like taxes, never going down. And condo fees have not increased that much in 4 years, since inflation has really upticked. And what's happening is all these buildings, especially the older buildings, it can be high rises, it can be garden style condos, they are band-aiding everything because they don't have the money to do so. They don't have to, because what happens is you can't just increase a condo association fee so high, because next thing you know, everyone's defaulting. People can't afford them, right? So then what do you do? So the insurance and the condo industry are both things that I'm really curious to see what's going to happen, because in most sectors or most real estate, like, there is a resale price, a reset number that potentially works, right? Like, let's say, some professional offices just don't operate. There's still like a reset number that you can lend off of, that, hey, we're going to go and move this building to this, right? There's still a number that works, but I don't know what happens with this insurance stuff and this condo stuff. Like, it's scary, actually.
Condos are, listen, nobody nobody gets surprised by, big expenses like a condo association. No idea what they're doing. Right. I mean, you get a bunch of guys, like one guy's a veterinarian and another guy's a lawyer, and then they're the guys that are managing the building. It's like they don't.
They don't.
I've seen a lot of because of that. I've seen a lot of deconversions, which I've seen now. I've seen buildings that went from multifamily converted to condos and now are getting converted back. It's like,
and the right real estate market, in the right market. And the right area that can support it with land value, it's fine. But like, there's a lot of places that can't.
I mean, some of these buildings just got to go. Like some of these live in Florida that sure know which ones we're talking about. Yeah, I mean, they just have so much deferred maintenance. Like it's not even worth it to.
Like eventually, it's just gonna collapse, which is scary. I mean, we look at it we see it real time just because there's a lot of. There might not be gigantic high-rise condos in the markets that we lend in, but there's still a lot of condo stuff, and they're all older style condo. Yeah,
buildings. But a lot of, the larger condo deals, like sure, those will make headlines, but how many 50-unit or 20-unit condo buildings are there out there? And those are even harder because like it's a much smaller pool of people to try to make up special assessments.
That's right, and. Even if it's an extra $100 a month per unit, like some people can't afford that.
Yeah.
Or a few $100 a month. I mean, I learned that firsthand. Early 2000s, I owned a condo that within like a year and a half, the condo fee went from $250 to $850 in a year and a half. Yep. And like it also was early 2000s to mid 2000s, so it spiked in value. So I was into the thing at like $100,000, right? And at one time, it was very close to being worth $300. Ended up selling it at $200 because $600,000 or $600 a month is equivalent to $100,000 of purchasing power, give or take, at that time. So like that was a good firsthand lesson that I didn't have to lose $1 on. But like everyone's like, why are you scared to lend on condos? They're so conservative. I'm like, because this shit could happen. Like they're especially the older style ones. Like it happens. I mean, if it's a newer garden style condo built in the 90s or recent, like you might not have as many issues, but 70s, 80s, it's challenging.
Oh yeah, there's some black cats in that building somewhere, man. Something's gonna happen.
Yeah. I don't know.
I personally don't get the whole condo thing. I owned a condo. It felt no different than just renting an apartment, anyways. But that they could change the rent on me overnight. So.
No doubt. No doubt. Yeah, no doubt. So I don't know. I think things like that and things like insurance, if you're not like vested in it and like it's not affecting you firsthand yet, you don't really notice it or see it. But it's a real thing. And I mean, I know a lot of private lenders in Florida, and they're like, I can't get insured. I can't. Like, what should I do? Should I lend on this building? Like, my loan's going to be $800,000, and the insurance company is telling me I can get whatever, $400,000, $500,000. And the good part is on some of those areas that are not insurable or, can't get full insurance on, at least the land values are very high. So at least, worst case scenario, you potentially still fire sale the land to recoup your interest, or your principal. But I don't know. It's definitely a concern.
It's tough, man. Especially if you're doing securitized deals like CMBS, Fannie, Freddie. Their insurance requirements are so strict.
Yeah.
And I mean, it's definitely full boat insurance, right? And there's no middle ground. And, when you're dealing with banks, and private lenders, sure, like most of those have much more lax requirements, but like, I mean, especially, multifamily, that's where I'm seeing people get really pinched on like the agency side. It's like, here's our insurance requirements and there's no getting around it. So go find it. And if not, we'll just place you in some incredibly expensive secondary market policy, anything we find.
Yeah. And like, here's what happens. Like, and we've been involved in forced place insurance policies on the lending side that we've had to buy secondary insurance.
Yeah. They're not the cheapest.
Ridiculous. And most of the big companies own those little companies anyways. And they're 2-3x the price, but whatever.
It all goes up to the same reinsurance.
Yeah, that's a different thing. It's all the same. That's a different conversation. But like, what does end up happening on a macro level when it's like, hey, I can't buy let's just say Tampa, for instance. There's no insurance available in Tampa. Then what? Does the whole freaking place like it doesn't necessarily collapse, but
it's a good question, right? Like,
got
how
to
do you fire
reset to a number
when you get into it and you're like, hey, actually, I can't get insurance for this.
I mean, I think they're having issues in California, aren't they? Didn't one of the big insurers, they just pulled out like on a residential level because of
wasn't it? Okay,
State Farm.
I think it was State Farm, and that may not be accurate. State Farm, but I think it was. I don't know. We'd have to double check that.
Yeah. Either way, do your due diligence. What I will say to everybody, if you're an operator, I don't care if you're doing single family, multifamily, self storage, any asset in between, you're a lender. Do your due diligence on the insurance because it is getting wild out there. End, like straight up.
What happened with insurance? Now, when we do this, it's become the same process as on the bank side, right? Like we do a wide net cast approach. Before, you would just auto renew, right? You'd find an insurance company, all right, it's done for the next 10 years, auto renew. Now, every single year, you should really be taking, and don't wait till the last minute. You should be taking that thing out to the market to as many carriers as possible. We've successfully lowered a lot of people's premiums because of that. But like, if you're going back to the same broker, and this, candidly, a lot of the large shops are not really the best options because they're like, we've got 4 or 5 guys we go to, or we just, auto renew stuff. There's a huge difference between broker to broker in the insurance space. A lot of times they have very different markets. So it definitely, that side, you definitely got to do a good amount of shopping to get the right deals.
Yeah. Yeah, man. Definite learning lessons. I think that's the competitive advantage if you have a debt broker that can take your insurance out at the same time, because I heard you saying it earlier. I'm like, God damn, that would be nice to just make one phone call and make life easier.
A lot of times. So we did, especially when you're doing like more securitized product, right? Because we were doing both of them, we were actually able to negotiate more with the lender and work more hand in hand.
That makes sense.
Which candidly, I'm thinking one deal in particular, I don't think it would have gotten done if it wasn't us doing it, right? Because we were able to get both sides to move on requirements.
Yep. Yeah, no, definitely makes sense. Jake, where's the best place people can find you out on the internet if they want to learn more about what your company does?
I'm exceptionally easy to find. LinkedIn, you can type my name into Google, our company, Clopton Capital. Call me directly anytime. I'm pretty accessible.
All right, we'll get that in the show notes. We appreciate you hopping on and talking to us where you think the market's going. And, who knew we would end up on an insurance conversation that's equally as crazy out there. Yeah. So it'll be fun to navigate, fun to follow. And we appreciate you coming on, brother.
Appreciate it, guys.
Thanks.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.